whoa, the market is not waiting around, and neither are we. SNDK just made a huge leap, and that means our old option strategy needs a serious update. So today, we're jumping right into a brand new play, what I'm calling aggressive income.
Okay, let's just start with the new reality on the ground. After that massive rally yesterday, SNDK is trading around $952. Now look, this isn't just some small bump. This is a total game changer, and it basically makes our old strategy obsolete.
And that really brings us to the big question, right? When a stock you're trading just explodes like this, what do? I'll tell you what you don't do. You don't just stick with the old plan. That's a recipe for leaving money on the table. So let's talk about how to pivot. To really get why this new play makes so much sense, we first got to take a quick look back at what we were doing before. It was a perfectly good strategy for yesterday's market, but the game has totally changed. So here's the deal in a nutshell. Our original trade was a cash-secured put with a strike price of $780. And at the time, that was a great spot. But now, with the stock blasting past $950, that $780 strike is so far away, so far out of the money, that the premium you'd get for selling it is just, well, it's peanuts. The opportunity has moved way up, and we have to move with it. So what's the answer? Well, we're not just throwing the whole idea out. We're getting smarter, we're adapting. And that's what this income aggressive update is all about. It's designed specifically to take advantage of this new higher price and, just as importantly, the crazy volatility we're seeing in the stock right now.
Okay, so here are the new marching orders. We are rolling up the position. Now, that's just a fancy way of saying we close out the old trade and open a new one at a better, higher strike price. So instead of that old 780, we are now looking at selling a cash-secured put at the 850 strike. And that May 15th expiration? That's chosen very carefully because it puts us in the perfect position for what's coming next.
All right, I know what you're thinking. Why this play? Why 850? Why this expiration? There are some really powerful reasons why this setup looks so good right now. And if you understand them, you can trade with a heck of a lot more confidence.
First up is just some classic, solid technical analysis. You see, that $850 level used to be a ceiling. It was resistance that the stock really struggled to break through. Well, now that it's smashed through it, that old ceiling is very likely to become the new floor. It's now a support level, and that makes it a much, much stronger foundation to sell a put against.
Now, before we hit the next point, we got to quickly talk about a critical idea, implied volatility, or IV. All it is really is a measure of fear and uncertainty. It's the market's guess about how much a stock is going to swing around in the future. And when IV is high, it means people are expecting big moves, and that fear gets baked into the option prices, making them way more expensive. And for us as option sellers, expensive is exactly what we want to see.
And this is where it gets really interesting. Right now, SNDK's implied volatility is cranked up to 118%. That is just incredibly high. It's rich. This is the engine that's powering our entire trade because it means we can collect a huge premium for selling this put.
So you're probably asking, why on earth is the IV so juiced up? Well, this timeline tells you everything you need to know. First, you have the stock being added to the NASDAQ 100 on April 20th. That's a big deal. But even bigger, the earnings report, which drops on April 30th. These known events create a ton of uncertainty, and all that uncertainty is what pumps up that implied volatility.
Now, here's the real heart of the strategy. We sell the option now, while everyone's nervous and that premium is fat and inflated with all that volatility. Then, after the earnings report comes out on April 30th, win or lose, a whole lot of that uncertainty just vanishes. And when that happens, the implied volatility is likely going to plummet. That's called IV crush. And that collapse in volatility is a direct profit for our position. It's beautiful.
Okay, so let's put a bow on this. Let's bring it all home. What are the big takeaways from this income aggressive play? Well, it all boils down to two simple things: a fantastic premium and a really solid cushion of protection.
And that brings me to the other beautiful part of this trade, the protection. Because of that high premium we get to collect, we're building in a safety net of about 10.7%.
So what does that actually mean for you? It means the stock can fall over 10% from where it is right now, from that 952 level, before our 850 strike is even in danger of being assigned. That gives us a huge margin for error. We can be wrong about the stock's direction in the short term and still walk away with a profit. That's a powerful position to be in.
So I'll just leave you with this final thought. A strategy like this is all about staying active and adapting to what the market is giving you. Because in a market that's flying this fast, sometimes the biggest risk of all is just sitting on your hands and doing nothing. This play is about taking that volatility, that thing that scares most people, and turning it into a real opportunity.